In this module, we'll dive into risk analysis in real estate finance. We'll learn how to evaluate key risks like market fluctuations, interest rates, liquidity, and default potential. Understanding these risks is crucial to making smarter decisions about properties, financing options, and long term investments. From identifying where you're exposed to testing different scenarios and strategies, this module will help you get comfortable with uncertainty before you invest. We'll introduce a risk lens that will guide you in assessing real estate opportunities, especially as economic conditions change. This foundation will set you up to make more informed, confident choices in the real estate market. When we talk about risk in real estate investment, we're really focusing on the possibility that the actual returns might not match what we initially expect. This means there's always some level of uncertainty involved. Factors like future rents, property values, financing terms, and market demand are never fully predictable, which adds to this uncertainty. Additionally, variability plays a big role. Investment outcomes can change as economic conditions shift or as the property itself performs differently than anticipated. This highlights why understanding risk is so crucial. By analyzing these risks carefully, investors can make more informed choices about which properties to invest in, decide on appropriate levels of debt, and develop strategies that better manage potential downsides. Essentially, risk analysis is about preparing for these unknowns to improve decision making. Risk analysis is crucial for several reasons. First, it helps protect our capital by identifying potential downsides before we commit funds. This means we can anticipate issues related to rents, interest rates, or vacancy rates, reducing the chance of costly surprises down the line. Additionally, risk analysis allows us to evaluate opportunities more accurately by comparing expected returns against the risks involved. This process helps us distinguish resilient investments from those that are more fragile or risky. It also supports important decisions around pricing, leverage, and timing to ensure we're making the best choices. On a broader level, risk analysis aligns our overall strategy by matching investments to our goals and risk tolerance, choosing financing methods that fit current market conditions, and ultimately building a stronger portfolio for the long term. So, it's not just about avoiding losses. It's about making smarter, more informed investment decisions. Let's dive into the four major types of risk, their core exposure areas in real estate investments. First, we have market risk. This involves the possibility that property values or rental income may fluctuate due to changes in supply and demand dynamics, rental rates, or overall economic conditions. It's crucial to understand because these external factors can significantly impact your investment's performance. Next is interest rate risk. This risk arises when borrowing costs or discount rates change, affecting financing expenses and cash flow. If interest rates rise, it can increase your costs and reduce the value of your investment. Conversely, lower rates might improve profitability, so monitoring this risk is essential for effective financial planning. Third, liquidity risk refers to the challenge of selling or refinancing a property quickly without facing delays, higher costs, or having to accept a lower price. This risk matters if you need to access cash or exit an investment promptly, emphasizing the importance of market conditions and property type and liquidity. Finally, default risk involves the chance that a borrower or tenant fails to meet payment obligations. This can reduce your expected returns or even cause losses if the default is severe. Managing tenant quality and creditworthiness is key to mitigating this risk. Understanding these four risks, market, interest rate, liquidity, and default, is fundamental for thorough risk analysis and making informed investment decisions. Market risk refers to the possibility that the value of a property or the income it generates will decline due to changes in local or broader market conditions. For example, an economic downturn can lead to decreased demand and lower rents, impacting the profitability of a property. Similarly, if the population in an area declines, it can weaken occupancy rates and reduce pricing power. Neighborhood deterioration is another important factor, as it diminishes the attractiveness of an area, which in turn lowers property values. Essentially, real estate performance is closely tied to the overall market environment. Even if a property is managed exceptionally well, it can still lose value if the surrounding economy, demand base, or neighborhood momentum shifts negatively. Understanding these risks is critical for conducting thorough risk analysis and making informed investment decisions. Let's take a closer look at how interest rate risk impacts real estate investments, especially when rates start to rise. Starting with the current low interest rate environment, cheaper debt means investors can secure stronger deals. Lower borrowing costs lead to lower debt service, which means more cash stays in the hands of investors. This enhances loan affordability and improves debt coverage ratios, supporting higher property values. Essentially, with favorable financing conditions, it becomes easier to acquire, refinance, and hold properties since projected cash flows more comfortably cover loan obligations. However, the scenario shifts when interest rates begin to rise. Higher rates compress returns because financing costs go up, leaving less income available after debt payments. This results in higher debt service and reduced borrowing capacity, making it tougher to refinance existing loans. The increased costs put downward pressure on property values, since buyers generally adjust the prices they're willing to pay based on higher financing expenses. Overall, rising rates increase risk exposure. As payments grow, cash flow weakens, and investors face more challenges in maintaining property values and managing debt. Understanding this balance between low and rising rate environments is crucial for effective risk analysis and investment decisions. When interest rates fall, property values generally go up, which creates new refinancing opportunities. Lower rates mean the cost of debt decreases, leading to improved cash flow. For example, refinancing from a 7.5% rate down to 6% can significantly reduce the annual debt service payments, easing payment pressure. This reduction in debt costs can boost the debt service coverage ratio, offering stronger coverage and even potential to pull out equity. Cheaper capital also supports higher asset values, as buyers are willing to pay more when discount rates are lower. This effect, known as yield compression, can lead to an approximate 8 to 12% value gain. Exit strategies may improve as lower rates raise the present value of the property, but these benefits hinge on income stability, favorable lender terms, and market confidence that rates will remain low. Overall, falling interest rates provide substantial advantages through refinancing benefits, reduced debt service, and appreciation potential, though it's important to carefully analyze the risks based on specific market and property conditions. Liquidity risk is one of the key challenges in real estate investing. Even if a property looks valuable on paper, it can be difficult to sell quickly when you need cash. The time required to sell a property often stretches much longer than expected, especially if the market is slow. This slow absorption means there are fewer buyers or tenants ready to act immediately. In situations where a sale is forced, owners often have to cut prices, which reduces the actual returns they realize. Because these assets are liquid, they demand patience. When the market slows down, transactions can stall, and the timing of exits becomes a significant source of investment risk. Understanding this risk is crucial for anyone involved in property investment. When we talk about liquidity risk, market conditions play a crucial role. Liquidity varies depending on the type of asset and the depth of the market. Essentially, the harder it is to sell an asset quickly at a fair price, the higher the liquidity risk becomes. Let's break it down further. Highly liquid assets are those that can be sold quickly because there are many buyers and pricing is transparent. On the other hand, illiquid assets take longer to sell, have fewer buyers, and face greater pricing friction, which makes it harder to get a fair value promptly. For example, cash is the most liquid asset, followed by public REITs, which are relatively easy to trade. Apartments and industrial properties come next, while office buildings and raw land tend to be more liquid. Market conditions influence this too. In stable markets, frequent transactions help improve price discovery and shorten the time it takes to sell an asset. However, during periods of tight credit, buyer demand decreases, widening the gap between what sellers ask for and what buyers are willing to pay. In distress periods, even solid properties can suddenly become difficult to sell, increasing liquidity risk significantly. Understanding these factors is key to analyzing liquidity risk properly and making informed investment decisions. Default risk refers to the possibility that a borrower won't be able to meet their loan obligations. This risk tends to increase when several factors, like cash flow, leverage, and borrower quality, all weaken at the same time. There are four main factors that shape this risk. First, income stability plays a crucial role. When a borrower has reliable and consistent income, they're much better positioned to make their loan payments on time. Next is the loan to value ratio. This measures how much of the property's value is financed by debt. A higher loan to value ratio means there's less equity cushion, which raises the chances of payment stress if something goes wrong. The third factor is debt service coverage. This compares the property's cash flow to the debt payments. A stronger cash flow relative to debt reduces the likelihood of default because the borrower has more funds available to cover the loan. Finally, credit history is a key indicator. Past repayment behavior gives us insight into how a borrower might handle financial pressure in the future. A solid credit history generally signals a lower risk of default. Understanding these four factors helps us analyze default risk more effectively from the borrower's perspective. When lenders evaluate default risk, they focus on several key stages. First, during origination, they carefully review the borrower's credit history, assess the debt service coverage to ensure the borrower can meet payment obligations, and evaluate collateral along with loan-to-value tests to determine the security of the loan. Next, during servicing, lenders monitor payment performance closely, keep an eye on property income, and check for compliance with any loan covenants to catch early signs of potential problems. Finally, if issues arise, lenders move into loss mitigation, exploring options like loan restructuring, workout, or forbearance plans, and developing foreclosure recovery strategies. This comprehensive approach helps lenders manage and minimize default risk throughout the life of the loan. On this slide, we're looking at the complex relationships between different types of risks and how they interact with one another. Starting with market risk, we see that values and rents fluctuate based on changes in demand, supply, and overall economic conditions. When the market shifts, it doesn't just affect prices, but also influences other risks. Interest rate risk, for example, deals with how debt costs and required returns change as interest rates go up or down. This can impact the affordability and profitability of investments. Now, when interest rates rise, it can increase debt servicing costs, tightening the financial pressure on owners. Moving to default risk, this becomes more likely when income or asset values decline. If cash flow decreases, meeting payment obligations becomes harder, elevating the chance of default. This links directly to liquidity risk, where limited exit options or a thin pool of buyers can magnify losses and delay potential solutions. Closely associated with liquidity risk are concepts like pricing pressure, refinancing strain, for sale risk, and thin buyer depth. These factors can combine to worsen outcomes during market shocks, which tend to spread rapidly. Cash flow stress here refers to the financial strain caused by these interrelated risks. The key takeaway is that risks rarely operate in isolation. Instead, they often move together, amplifying the overall impact. Understanding these relationships is essential for effective risk analysis and management. Here, we outline a comprehensive risk assessment framework designed to guide effective decision-making. First, we start by identifying risks, focusing on key exposures such as market fluctuations, interest rates, liquidity challenges, and default potential. Next, we quantify these risks by measuring their likely impact on cash flow, asset value, and financing conditions. Then, we model various scenarios to understand how outcomes might shift under different economic or property market conditions. After that, we compare alternatives by evaluating options across different assets, financial structures, and underlying assumptions. Finally, we make a well-informed decision by selecting the strategy that offers the strongest balance between risk and return. The crucial point here is that analysis should always drive decisions. This structured, repeatable framework transforms uncertainty into actionable investment choices. Let's talk about sensitivity analysis, which is an important tool in investment decision-making. Essentially, sensitivity analysis examines how changes in one assumption affect the overall investment results while holding all other variables constant. This helps us identify which factors have the biggest impact on outcomes and where the investment might be most vulnerable. For example, consider rental rates as the variable we test. If rental rates increase by 5%, the projected internal rate of return, or IRR, rises to 9.2%. When rental rates increase by 10%, the IRR improves further to 11%, and at a 15% increase, it reaches 12.7%. This clearly shows that rental income significantly influences the investment's profitability. So, by testing different rental rate scenarios on the same property, we gain insights into potential returns and risks. Sensitivity analysis is a valuable part of risk analysis because it pinpoints which assumptions are critical and helps us prepare for various market conditions. Here, we're looking at sensitivity analysis focusing on a single variable, specifically the occupancy rate, and its impact on net operating income or NOI. The key idea is to hold all other factors constant and only change one assumption at a time. This helps isolate the effect of that particular driver. As we adjust the occupancy rate, say, decreasing it by 10% or increasing it by 12%, we observe corresponding changes in NOI. For example, a 10% drop in occupancy might lead to a 12% reduction in NOI. Conversely, a 10% increase in occupancy could boost NOI by about 12%. This relationship is visualized as a single input sensitivity curve, where a steeper slope indicates greater exposure or risk tied to changes in that variable. The takeaway is clear. Even relatively small shifts in occupancy rates can cause measurable changes in property income, highlighting the importance of closely monitoring and managing this driver in risk analysis. Here we have a sensitivity analysis that looks at how investment returns shift when both rent and occupancy rates move together. It's important to recognize that a single assumption rarely tells the whole story. Instead, taking a two-way view allows us to see how combined changes affect the internal rate of return or IRR outcome. This heat map illustrates the projected IRR under various combined scenarios of rent changes and occupancy levels. You can see that the best outcomes occur when both rent and occupancy are strong, compounding favorable assumptions for higher returns. On the other hand, the downside is clear. Low rent coupled with weak occupancy compresses IRR fastest, significantly reducing potential profitability. The key takeaway is to test paired variables rather than looking at just one input in isolation. By doing so, we get a more realistic picture of the risk and return potential, helping us make better informed investment decisions. Here we have a scenario testing divided into three cases: best case, base case, and worst case, each outlining different market conditions and their impact on returns. Starting with the best case, we anticipate strong demand and a faster lease-up period, which drives rents to grow by 6% annually. The exit cap rate compresses to 5%, leading to a sale around year 5 at near peak pricing. This scenario yields the highest return, with an internal rate of return or IRR of 18.4%. The equity multiple here is 2.1 times, meaning investors could more than double their investment, and the cash-on-cash return is a solid 9.8%. The base case reflects a stable market with normal absorption rates. Here, rents grow more modestly at 3% annually, and the exit cap rate remains steady at 5.5%. The property is sold at year 5 under expected market terms. This scenario results in a respectable 13.1% IRR, a 1.7x equity multiple, and a 7.1% cash-on-cash return, reflecting solid, steady performance with less risk than the best case. Finally, in the worst case, demand weakens and vacancy rises, causing rents to decline by 4% before leveling off. The exit cap rate expands to 6.5%, and the sale is delayed due to lower pricing at exit. Here, the IRR drops significantly to 6.2%, with a 1.2x equity multiple and a 3.4% cash-on-cash return, indicating much tighter returns and highlighting the increased risks if market conditions deteriorate. This risk analysis helps us understand a range of potential outcomes and guides decision-making by showing how different market dynamics can impact investment performance. Here, we're building a stress test scenario to understand how potential negative changes could impact our investment. Imagine within 2 years, property values drop by 20%, rental rates decline by 10%, vacancy rates increase, and refinancing happens at a higher interest rate. When we model these conditions, we see a significant reduction in investment performance. The internal rate of return, or IRR, falls by 5.2 percentage points, dropping the projected return from 12.4% down to just 7.2%. At the same time, the asset value takes a hit, decreasing from $10 million to $8 million. which is a 20% loss. Cash flow is also affected, compressing by 18% because lower rents combined with higher financing costs squeeze the net operating income. The key takeaway is that stress tests convert these negative assumptions into tangible, measurable outcomes. This allows us to evaluate risks realistically and make informed decisions about financing, pricing, and how long to hold an investment before committing capital. When we talk about risk-adjusted return analysis, the key idea is that higher risk investments need to offer higher expected returns to justify taking on more uncertainty. Essentially, as your exposure to risk goes up, so should your expected return. Looking at common investment options in real estate and capital markets, we see a spectrum of risk levels. Bonds represent the low risk end, characterized by low volatility and consequently lower expected returns. They're aimed primarily at capital preservation with limited upside potential. Moving up the scale, stabilized properties carry a moderate level of risk. These investments usually provide steady cash flow and offer a balanced mix of income and appreciation, resulting in mid-range returns. At the high-risk end are development projects. These come with considerable uncertainty during construction and lease-up phases, but they promise the highest expected returns to compensate for this elevated risk. The fundamental decision rule here is straightforward. Only choose an investment if the expected return adequately compensates for the risk you're taking. This risk-return trade-off is critical in making smart investment choices and ensuring your portfolio aligns with your risk tolerance and financial goals. When using risk analysis in property selection, it's important to focus on several key factors. First, consider location stability. A property in a stable area tends to hold its value better during market fluctuations. Next, evaluate the market fundamentals, such as demand, supply, and economic conditions, which influence long-term growth potential. Then, assess the asset quality, including the condition of the property and its suitability for the intended use. Don't forget to analyze the debt structure, ensuring the financing terms are manageable and offer flexibility. Finally, look at exit options to confirm there are realistic ways to sell or refinance the property when the time comes. The best properties are those that can withstand pressure by combining strong fundamentals with flexible financing and clear exit strategies, helping you minimize risk and maximize potential returns. When we talk about risk in financing decisions, it's important to understand how the financing structure can either amplify a company's exposure to risk or help absorb financial shocks. On one side, aggressive financing carries higher risk. This typically means high leverage, floating interest rates, and short-term debt. While this approach offers more upside potential, it also leaves much less margin for error, increasing vulnerability to market fluctuations. On the other hand, conservative financing involves lower risk with moderate leverage, fixed interest rates, and longer-term debt. This strategy tends to provide lower returns but builds stronger resilience against economic downturns and unexpected shocks. Balancing these approaches is crucial in managing the overall risk profile of the company. Effective risk analysis helps identify which financing structure aligns best with the company's goals and risk tolerance, ensuring financial stability and growth potential. Let's talk about the debt service coverage ratio, or DSCR, which is a crucial risk metric used by lenders. The DSCR is calculated by dividing the net operating income by the debt service. Essentially, it shows how well an entity can cover its debt obligations with its operating income. A higher DSCR indicates a bigger cushion of income to cover debt payments, which reduces the risk for lenders. Typically, a DSCR greater than 1.2 is considered acceptable, meaning the business generates enough income to comfortably cover its debt. To put it simply, if the DSCR is below 1.0, that's a red flag because it means the company's operating income isn't even enough to fully cover its debt. At 0.9, the risk level is high. When the ratio is around 1.2, it's acceptable, and a DSCR 1.4 or higher is considered strong, signaling low default risk. In summary, monitoring this ratio helps assess financial health and risk exposure, with higher values reflecting a safer position in terms of debt repayment. Let's take a closer look at the loan-to-value ratio, or LTV, which is a crucial measure of leverage and risk in property financing. Essentially, LTV compares the amount of the loan to the value of the property. When a borrower puts in less equity, meaning a higher LTV. There's less of a cushion if property values drop, increasing risk. For example, an LTV of 60% is considered conservative. Here, the borrower has substantial equity in the property, which reduces risk. At 75%, which we call moderate, the risk increases as the borrower relies more on debt. And at 90%, it's very aggressive, meaning the borrower has very little equity and the risk is significantly higher. Higher LTV means higher risk because a thinner equity cushion can lead to a higher chance of default, especially if cash flow falters or the property's value declines. While taking on more debt through higher leverage can potentially boost returns, it also amplifies potential losses on the downside. So, LTV is a key signal in risk analysis and decision making, helping us balance the potential rewards against the risks involved. Here, we see how a single location can encompass multiple property drivers through a mixed-use environment. This example includes residential apartments, offices, retail spaces, and industrial assets, each making up a different portion of the overall portfolio. Apartments account for 32%, offices 21%, retail 23%, and industrial 24%. The core idea behind this diversified mix is that having different income streams helps to stabilize overall portfolio performance because these asset types react differently to market changes. By spreading exposure across various property types, we effectively manage portfolio risk and reduce concentration risk, ensuring that if one segment weakens, the entire portfolio isn't overly impacted. This thoughtful approach to diversification is key to maintaining steady returns in a fluctuating market. Market cycles play a crucial role in reshaping exposure and risk assessment in real estate. It's important to understand that the same property can appear very different depending on the cycle phase. It might seem resilient during recovery, aggressive at the peak, and vulnerable during contraction. During the expansion phase, rents and property values are rising, often quickly. However, this rapid growth can mask signs of overheating and overly optimistic underwriting assumptions. Moving into the peak phase, pricing reaches its strongest point, but downside risks also increase as affordability tightens and demand starts to wane. In the contraction phase, challenges become more apparent. Vacancy rates rise, refinancing pressures mount, and liquidity weakens, all of which can expose assets that don't have strong cash flow foundations. Then, during recovery, selective opportunities begin to emerge. However, success depends heavily on factors like timing, tenant demand, and access to capital. Throughout these phases, real-world market signals, such as development activity, price and momentum, tenant behavior, and capital flow give essential clues about current conditions. Understanding these signals is key for effective risk assessment and making informed decisions in dynamic markets. Here, we're looking at a complex picture of economic indicators and their signals for risk. This environment is mixed, meaning some factors point to low risk, while others raise concerns that we can't ignore. It's crucial to observe how key elements like growth, interest rates, pricing, and occupancy interact before making decisions about underwriting risk. Starting with GDP growth, is at a low risk level of 2.4% and trending upward. This steady expansion is good news because it supports leasing demand and boosts investment confidence. On the flip side, unemployment is a high risk factor right now at 5.8% and rising. Increasing job losses can weaken rent collections and reduce space absorption, which could hurt returns. Interest rates are also posing high risk, sitting at 6.25% and climbing. Higher borrowing costs put pressure on property values, refinancing options, and debt coverage, making it harder to manage financial obligations. Inflation is somewhere in the middle, at moderate risk with 3.6%, but it remains stable. Despite the stability, sticky inflation keeps operating costs high, which can squeeze profits even if revenue growth slows down. Rental growth is low risk at 4.1% and on the rise, which is a positive sign. Increased rent momentum can help offset inflation-driven cost increases and support your net operating income. Vacancy rates, however, are moderate risk at 8.7%, though they are decreasing. Improved occupancy rates are encouraging, but the level of vacancies still calls for caution. Overall, this macro dashboard underscores the importance of a balanced view on risk. where growth factors are favorable but challenges like unemployment and rising interest rates need close monitoring as part of your risk analysis. When communicating risk to stakeholders, clear and concise reporting is essential to transform complex analysis into actionable decisions. Start with an executive summary that immediately answers the most critical questions. What is the overall risk level? What are the main drivers? And does the opportunity still align with our strategic goals? This summary should be a brief paragraph that provides a clear investment view, highlights the top risk exposures, and directs decision makers to the issues that need urgent attention. A risk dashboard serves as a visual snapshot of key risks, covering areas like market, rates, liquidity, and default. This allows stakeholders to quickly assess where exposure is low, moderate, or high, making comparisons straightforward and effective. Sensitivity tables break down how changes in key variables, such as rent, occupancy, and rates, impact net operating income. For example, a 5% increase in rent might boost NOI by 6.1%, while a 5-point drop in occupancy could reduce it by 7.4%. These impact tables illustrate how shifts in assumptions affect value, cash flow, or coverage ratios under different scenarios. Finally, a narrative explanation is crucial to interpret the numbers by linking them to broader market conditions, financing structures, and potential consequences for the investment. For instance, refinancing risk may rise if interest rates remain elevated, and the investment's value tends to be most sensitive to occupancy losses. Effective risk communication also involves highlighting mitigation strategies, such as maintaining stronger cash reserves to address these vulnerabilities. This approach ensures stakeholders fully understand the risks and can make informed decisions. When we talk about risk analysis, it's crucial to avoid making bad assumptions that can make even good deals seem safe. One common mistake is assuming that historical trends will continue indefinitely. Past performance might look steady, but it can mask potential turning points. So it's important to retest your assumptions as market conditions change. Another pitfall is ignoring the correlation between different risks. For example, vacancy rates, interest rates, and property values often move together. Failing to analyze how these factors interact in a downside scenario can lead to underestimating overall risk. Also, overemphasizing best-case scenarios can distort your expected returns. Optimism is natural, but decisions should be anchored in realistic base and downside cases to avoid surprises. Finally, not stress testing critical assumptions leaves hidden vulnerabilities unaddressed. Pushing variables like rent, interest rates, timing, and exit values harder helps identify where a deal might break. Strong analysis isn't just about what could go right. It's about rigorously testing what could go wrong. Now, let's dive into some effective risk mitigation strategies that are crucial for managing financial and operational uncertainties. First, diversification plays a key role. By spreading investments across various property types and markets, we significantly reduce concentration risk. This approach helps avoid overexposure to any single sector or geography. Next, adopting conservative finance practices is essential. This means maintaining moderate leverage and focusing on fixed interest rates to control debt exposure, which keeps financial obligations manageable even during volatile periods. Insurance is another vital component. By ensuring adequate property and liability coverage, we transfer key losses to insurers, protecting the business from unexpected large expenses. Finally, maintaining liquidity reserves is critical. Keeping capital available for contingencies allows the organization to stay flexible and responsive under stress, ensuring it can navigate challenges without compromising long-term stability. Together, these strategies form a comprehensive approach to analyzing and mitigating risk effectively. Here we have a hypothetical investment scenario focused on a stabilized suburban office asset. This property is a 120,000 square foot multi-tenant office building, which serves as a representative asset for our scenario testing. The acquisition price is set at $24.5 million, reflecting a 7% capitalization rate. For financing, the deal assumes 65% loan-to-value with fixed-rate debt and a 25-year amortization schedule. The investment horizon is a 7-year hold, with plans to refinance or sell the property between years 5 and 7. This setup allows us to comprehensively evaluate key risks, including leasing risk, refinancing exposure, exit pricing, and the overall resilience of cash flow. By varying assumptions around rent, the cap rate, and financing terms, we can see how sensitive the investment is to changes in market conditions. This case study highlights the importance of thorough risk analysis in making informed investment decisions. As we look at emerging risks, climate and ESG factors are becoming critical in risk analysis. It's no longer just about rates and rents. Now we must consider how climate exposure and ESG performance impact property value, operating costs, financing, and demand. Climate risks such as flooding, heat stress, and drought can raise insurance premiums, disrupt daily operations, and threaten the long-term resilience of assets. On the ESG side, incorporating sustainability features and strong governance helps with tenant retention, ensures compliance with regulations, and boosts future marketability. Investors increasingly ask whether a property can remain resilient and competitive over time. This shift means that modern resilience is not just a concept, but something that is investable. Green infrastructure and efficient design have become essential components in real estate risk assessments, reflecting how the market values sustainability and risk mitigation. When it comes to risk analysis, the first thing to understand is that risk is inherent in any investment or project, and it's essential to quantify it accurately. You can't eliminate risk entirely, but by measuring it carefully, you can make more informed decisions. One effective tool for this is sensitivity analysis, which allows you to test different assumptions and see how changes in key variables impact outcomes. This helps identify which factors have the greatest effect on risk and where you should focus your attention. Diversification is another crucial strategy. By spreading investments across different property types and markets, you can reduce exposure to any single source of risk. This approach balances your portfolio and helps safeguard against localized downturns or sector-specific challenges. Lastly, continuous monitoring of economic indicators is vital. Conditions change over time, and staying informed on trends like interest rates, employment figures, and market demand enables you to adjust your risk management strategies proactively. These fundamentals form the backbone of effective risk analysis and help ensure more resilient and successful investment decisions. Now that we've covered the fundamentals of risk analysis, let's talk about how you can apply it to your own investment decisions. First, start by identifying the risks associated with your current or target investment. Understand what factors could affect the outcome. Next, run sensitivity analyses on key variables to see how changes in these factors impact your potential returns. This helps you grasp the range of possible outcomes and their likelihood. Then, develop a risk-adjusted decision framework, an approach that incorporates risk assessment into your decision-making criteria instead of focusing solely on potential gains. Finally, turn this risk analysis process into a repeatable investment strategy. By doing so, you create a disciplined approach that tests your assumptions up front, ultimately leading to better informed decisions before you commit any capital. Remember, the goal here is to make your investment choices more robust and resilient by proactively managing uncertainty.